Okay. All right. Well, I'd like to thank you very much for your time today. My name is Martine Lachance. I'm an investment retirement planner with RBC, and we'll just go over the Robinson Huron Treaty Financial Workshop, I should say. So we'll go to the next page, Ryan. Okay. So a little bit about myself. As I said, I'm an investment retirement planner with RBC. Part of my role is I work with clients to provide them some assistance through financial, how can I say this, circumstances throughout their lifestyle or their life events, whether it be planning for retirement, transitioning into retirement, could be also receiving an inheritance, settlement, so on and so forth. So that's the focus of my role. And I'll also pass the mic to Jay. He's the branch manager with Sturgeon Falls, here to provide some support.
Yeah. I'm Jay Lydiard. I'm the branch manager at the Royal Bank in Sturgeon Falls. I'm here to help answer any general questions that individuals may have about banking, mortgages, that kind of thing, but also just to kind of introduce myself, because I am available at the branch Sturgeon Falls. So if anybody has any questions or to set up with any other advisors or set up an appointment with Martin there. So.
Perfect. So the purpose of this presentation, it's not to guide you towards certain investments or products. Instead, it's to provide some advice to better prepare for a life event that you'll be going through in the next couple of months. We'll go over some things to consider. Tax-free savings account, TFSA, is a popular subject at the moment, so we'll definitely go over that as well as cover other financial accounts. We'll highlight the importance of advice, and at the end, we'll answer any questions that you may have. Ryan. All right. So financial planning is not cookie cutter. The recommendations I may provide for yourself may be different to someone else based on your personal circumstances and your preference. So what you see here on the screen, they are your Future by Design life cards. Essentially, most financial decisions that you will make throughout your lifetime will be influenced by one of these 8 cards. So in order to provide the best recommendations for you, it's to truly understand what's important to you. So when focusing on these cards, I'll give you an example. One of the cards that I would often get from clients would be a house. Whether it be wanting to gift the house to their children after passing, purchase a new house, or do extensive renovations. Those are all great goals. So let's go with an example of home renovations. So it's important to know the details, whether they are you looking to just update the kitchen, or are you looking to do an extensive renovation? Because that will obviously have a significant impact on the financial implications. So Ryan, we'll go to the next page. So once we determine what's important to you, we want to focus on maybe 1 to 3 of these cards and really understand the financial implications of these cards. So again, with the renovations, if you're doing kitchen renovations or extensive renovation, try to be as specific as possible to what are the associated costs with that specific goal, and as well the time frame, because the recommendation for extensive renovations that you're looking to do this year versus 2 to 3 years from now will be significantly different. So that would be the first step, is to truly understand what is important to you so I can provide the best options. So we'll go to the next page. Now, once we understand what's important to you, this example on the screen is My Advisor. It's a digital platform that you also have access through online banking for RBC clients. And it's extremely user-friendly. You can input your goals and you can tweak it accordingly. So you can see here on the screen for this individual, their goal is to retire at 55. with an income of $3,000 a month. They're currently contributing $500 to attain this retirement goal. And this allows you to make any changes, whether you want to increase the contributions, add a lump sum, and it gives you an idea of how on track you are to attain your goal. So you can see here, this highlights retirement goal, but you can also review other potential goals, whether it be a vacation trip, kids' education, home renovations, home purchase, so on and so forth. And having a plan is truly important because the decision you make today will have a significant impact on yourself and your family tomorrow. So I love the saying by Warren Buffett, someone is sitting in the shade today because someone planted a tree a long time ago. So again, it comes down to planning. Making the decision today will significantly impact tomorrow. I'll go to the next page. So now that we have a good understanding of your objectives, what's truly important to you, this is where we can start looking at, some recommendations to find some successful investing options. So first consideration would be set your goals, which we already highlight. You want to be as specific as possible. But you also want to focus on the time horizon because the time horizon of your goal can significantly have an impact on the recommendations we would offer, and as well as potential risk tolerance that you're willing to take. So 3 would be consider your risk tolerance and understand risk. So risk tolerance is the ability to accept fluctuations in your investments, and it's important to align the investment strategy with your comfort level. Now, in terms of understanding risk and high-risk investments, something to be considering is while high-risk investments may potentially offer higher return, they could also offer potential for greater loss as well. So be cautious about that. And also, if there's an investment that sounds too good to be true, it could also be too good to be true as well. So the 4th one would be diversify. So diversification is the key to managing risk in your investment portfolio. And you can do this by spreading your investments across different asset classes, industries, and geographical locations. So by doing that, by diversifying your investments, you could significantly reduce your risk, but also, so this would provide a safety hedge, but provide some opportunities as well, growth opportunities. So the 5th one would be monitor your investments. So once you invest, it's not one and done. This is something we recommend that you monitor at least on an annual basis, especially through, life does change throughout life circumstances. And by monitoring your investments, it's just to ensure that you're still within your comfort level, your risk level, and your time horizon. If once, you're approaching retirement, then you definitely want to make some changes. And last one is to seek professional advice. So if you're looking to make some investments, I highly recommend speaking with a professional just to ensure that you're making, the best decision for today and as well as tomorrow. So we'll go to the next page. All right, so as I mentioned, investments is definitely not, set in stones. You can certainly make some adjustments. And we typically have 3 levers of how you can make changes with your investments as your life circumstances will change over time. So the first lever is how much you invest. So once you work on, the plan, which will work with clients, you can see if you're on track to attain your goal. If you see you're short to attain your retirement goal or what other goal that you may have, you can potentially look at, increasing your contributions, increasing potential lump sum contribution, and vice versa. If you're way over your certain goal, you may look at reducing your contributions or an investment. Another option is you can change your time horizon, which it means how long you're looking to invest. So when you're considering your time horizon, this would naturally influence the risk you're willing to take with your investments. So by reducing the time horizon, you're less likely to accept fluctuations. And the lever 3 is how much risk you're willing to take. So every investment carries some sort of risk, and even guaranteed investment comes with some risk, known as inflation risk, which we'll cover that later on. We'll go to the next page. All right, so this page here, I'll be honest, it looks quite overwhelming, but really the purpose of this slide is to demonstrate the importance of diversifying your investments. So how it works, you can see from the left to the right, from the last 10 years, it demonstrates which asset allocation provided the highest return over the last 10 years, from the top to the bottom here. So when it comes to investing, one of the easiest way that you can manage your risk would be by spreading out your investments in terms of asset class, geographical locations, and industries. And when we highlight this, if you look at the top producers, you don't see there's a top producer for each and every year. So very important to diversify your investments. Okay, so other things to consider that we're going to discuss. We're going to discuss about inflation, which is, the natural increase in price of goods and services, which will decrease the value of your dollar. We'll discuss about unexpected risk and taxes as well. So on this slide here, this is an example from the website Bank of Canada. It's an inflation calculator over the last 20 years. And it demonstrates, so $100,000 in 2004, so 20 years ago, not that long ago. Today, you would need to have $154,000 to have the same purchasing power. So that's in 20 years. So essentially, the value of your funds, over half of the value of your funds disappeared over 20 years. And this is an annual rate of inflation of 2.19% per year. So if you're earning less than 2.19% in your account, checking, savings, or investment, you don't see it, but you're losing money every year. So I'll go to the next page. So now it's more important than ever to have your money work for you. I'm sure we've all felt it since COVID. Inflation, everything's costing a lot more, whether it be at the grocery, home purchase. So at the moment, as you can see here, it's the exact same calculator, but we're highlighting the last 4 years, so since COVID. So since COVID, the annual rate of inflation increased from 2.19 to 4.3.
Let's go back one.
Oh, we went too quick here. All right, so we'll review this page again. So this is in the pack inflation since COVID. So you can see from 2020 to 2024, percentage change during that 4 years, it increased by over 18%. So $100,000, if you had $100,000 in your checking account January 2020, today you would need to have at least $118,000 to have the same purchasing power. So that's why it's extremely important to have your money work for you. Now I'm ready for the next page. Okay. So this here is the power of compound interest. I just put an example of one of our balance fund during the same time frame, during the last 20 years, so from 2004 to now, and it's growth of 100,000. Now keep in mind, this is based on historical figures. It did indeed happen, but I can't guarantee the same results. So the growth of 100,000 from 20 years ago, you'll see the initial investment is 100,000, ending portfolio value is almost 288,000, compared to, based on the previous page, we need to have at least 154,000 to have the same purchasing power. So by investing, you can see that you're earning more than inflation. So we'll go on to the next page. So this page here highlights, once you invest for a certain amount of time, what can this investment do for you? So this is strictly an example for investment income. So the initial investment was 100,000 for 20 years. So let's pretend someone is investing 100,000. They don't touch it for the next 20 years when they retire. And after 20 years, that changed to 287. So let's round it up to 288,000. And they decide to withdraw 1,500 monthly for the next 30 years. Again, this is based on historical data. Can't guarantee you the same results, but this actually did happen. So initial investment started with 288, withdrew 1,500 monthly for 30 years, which equals to 541,000 during the time frame. And the end value is over 220,000. So again, this highlights the power of compound interest. Now keep in mind, this is not overly realistic, because 1,500 in 1994 is definitely not the same thing as 2024. Over time, you'll be looking to increase your monthly withdrawals. Okay, so here, this is a scenario that I worked with a client. I had a client who recently invested and was on track to retire online to attain their retirement goal. They were previously invested pretty aggressively, and they wanted to totally stop investing because of market volatility. And this scenario here, it compares the impacts of inflation versus market volatility. And this is why inflation is often considered as the silent killer. We don't see it, but it significantly has an impact on your investments. So on the right hand here, or I should say, let's start with the left hand. So this is an example with our planning software. We have an assumption that inflation is 2.1%, which is pretty much in line with the compound interest in the last 20 years from the previous calculator. But I increased it by 0.9%. So I increased inflation to 3%. His retirement goal decreased by a whopping 25%, simply because of inflation. Versus the other scenario, I kept inflation to 2.1%, but included a market drop of 30% that lasted 4 years. A 30% market drop is a pretty big market crash. I can't say it doesn't happen. It does happen, but it's rare. But it's a significant market drop that lasted 4 years. And you can see the impact on his retirement goal decreased to 8% versus 25%. So this is just to really highlight how it's crucial to have your money work for you, because inflation just eats it up really quickly. Okay. All right. Now we'll go over a few things to consider and components of estate planning as well. So first one is a will. So once you go through, a life-changing event, I always recommend my clients to implement their will. Not having a will can have a negative impact, unintended impact. So definitely get a will and potentially review it as well. So that would be one of the recommendations. One thing to consider, I think it's crucial, is account ownership. So quite often individuals will add someone on their accounts, whether it be a child or a sibling, to make the estate planning smoother, essentially. Now, there are some consequences of adding someone on the account. So with an example, mother and daughter. So the obvious risk is the daughter will have access to the funds at any time. So that's an obvious risk. Other potential risk is, let's say the daughter goes through a separation, divorce. Well, now her funds is at risk of asset splitting. So that's one potential risk. Another one is if the daughter is going through credit issues, bankruptcy, that could potentially put their funds at risk as well. And another one is if, let's say, the daughter goes through a legal battle, that could potentially put the funds at risk. So those little things that we don't always think about. So it's very crucial. So the other one would be naming the beneficiaries on a registered account. So this would be your tax-free savings account, RSP. Always recommend to have a review just to make sure that it's still aligned with your goals. And the other one is a power of attorney. So it's always a good plan to have a power of attorney. And this allows someone to act on your behalf, whether it be doing your regular banking, paying bills, or potentially even with your investments. Power of attorney, they're able to have authority, so you definitely want to have someone that you truly trust. They can do a lot of things, except for the key exception, they can't change the beneficiaries on your registered accounts. and they can't make any changes to your wills. So that's something to consider. Yeah, for sure.
I just want to add one little piece to the power of attorney. When the big difference between that and account join being account join is there's no ownership with the power of attorney. Don't apply with a power of attorney, but the power of attorney has the ability to help the individual pay their bills and do things on their behalf, but without the risk. So it is a very good option as opposed to joint ownership.
Excellent. So this one here, it's insurance. It is possible to be over-insured. So recommend to have a review of your insurance. And this could be your home insurance, life insurance. So have a review of your insurance. And last one here is trust. So trust can be a little bit more complicated. It's typically ideal for individuals with a blended family or with dependent adult children, and gives you the authority to have, I wouldn't say authority, but the ability to have a little bit more control of your funds once you've passed, but you could also have a living trust as well while you're still alive. So those are all little things to consider going through a life event. Okay. So the next step here is a hot topic at the moment is tax-free savings account. So we'll definitely focus on tax-free savings account. We'll also review some other registered accounts that may be available. So Ryan, we'll go to the next page. Thank you. So first one, tax-free savings account, TFSA. This one was introduced in 2009 as a way to encourage Canadians to invest. The big advantage of a tax-free savings account is all of the growth, all of the withdrawals are absolutely tax-free. So it's very flexible. So contributions, again, it started in 2009. It started very small and increased a little bit every year. So the contribution room is dependent on your age. So it's starting at 18 and the years of Canadian residency. So we can assume if you're born prior to 1991, lived in Canada your whole life, don't have another tax-free savings account, you can assume that your contribution room is $95,000, expected to grow a little bit each year. Best way to really know your definite contribution room is through CRA, my Canada Revenue Agency, which you have access online. Now, the thing with a tax-free savings account, it's only sole ownership. You can't have joint with someone else. It's sole, but you can, of course, add beneficiaries on the account. Now, more about the tax-free savings account. So the contribution room is added the next calendar year after the withdrawals. So as I mentioned, it's very flexible. You can contribute the money in, you can take it out. You just have to be careful to not over-contribute. For example, let's assume your contribution room is $95,000. You take out $10,000 for whatever reason, and you decide to recontribute. You'd have to wait until the next calendar year to recontribute, or else you'd be over-contributing and subject to penalty fees, which is 1% a month of whatever you contributed, which adds up pretty quickly. Now, another perk about a tax-free savings account, it's the withdrawals, unlike RSPs, they don't impact government benefits. So if you take money out of your TFSA, it's not considered an income, so it doesn't impact your old age security or guaranteed investment supplements. You can treat your tax-free savings account as, typical savings account, leaving it in cash, or you can also invest it accordingly to your risk tolerance. I typically don't recommend using a tax-free as a savings account because you're not earning enough interest to really benefit from tax-free growth, but it's definitely possible. Something to note, there's no creditor protection under the Federal Bankruptcy Insolvency Act, so just something to note. And as I mentioned, your TFSA contribution room will be available through CRA. Okay, so we'll review a couple other registered accounts. Some of them may not be beneficial for you, but I still wanted to go over them quickly. So one of them is an RSP or spousal RSP, which is a registered retirement savings account. So the contribution is tax deductible. So for that reason, if you work on the reserve, it really wouldn't provide you any benefits because all of the growth is tax-free, but the withdrawals that you do is considered taxable. So definitely would recommend speaking with someone before making an RSP contribution. Now you can use your RSP to purchase your first home or to return to post-secondary education. So how that works is for your RSP, you can withdraw up to $60,000 tax-free to purchase a home, or up to $20,000 to return to post-secondary education, but you do have to repay it over a certain amount of time. So for the first home, you have 15 years to repay it, and for educational reasons, you have 10 years to repay it. And the repayment process is just basically making RSP contributions. Now, we also have a first home savings account, FHSA, which is brand new. It came out last year. It's pretty much a hybrid between a tax-free savings account and RSP, meaning your contributions are tax deductible. You can use it to purchase. You can only use it to purchase your first home, but the withdrawals you don't have to repay them. So you make the contribution. It's tax deductible. You use the funds towards your first home and don't have to worry about repaying. But again, this account would not recommend if you're working on reserve. It's not giving you the benefit that there's better options. So there are some limitations with this account. So there's a limit of $8,000 contributions that you can do per year in a lifetime of $40,000. So we'll go to the next slide. Another account is a RESP, a Registered Education Savings Plan, which is great for individuals who are looking to save for their child's education. It could also be their grandkids, niece, nephews. And the benefit of this account is the government will match 20% up to $500 per year on your contributions. And that as well, there are some grants as well to benefit from. And there's a family group account. So let's say you have an RESP for 2 of your children. You're maximizing your contributions. So let's say $2,500 a year to get the 500 grants. And one of your child decide not to pursue post-secondary education. Well, the other one can use all of the grants. They can use both grants towards post-secondary education. So that's a big advantage. So another account is RDSP, Registered Disability Savings Plan. So it's a saving plan intended to help parents and others save for long-term financial security of a person who is eligible for the disability tax credit. So contributions in the RDSP are not tax deductible, and they can be made until the beneficiary turns 59. The big advantage of this particular account is the beneficiary can get a maximum of 300% matching grants, and a lifetime of $70,000 in grants over the lifetime. Okay, and one more account. We have also unregistered investment accounts. So typically, quite often, once the TFSA is maxed out, individuals will look at investing in an unregistered account. How this works, unlike the TFSA, it's only sole. It can only be one person, versus the unregistered investment account. You can have joint with a spouse, a family member if you'd like, but you cannot add a beneficiary on the account. Okay. So this page here is just the focus about working with a financial planner. I hope I was able to provide here some information that we certainly do more than working with investments. Working with a planner, we definitely look at other important aspects of your life, whether it be retirement and estate planning, tax planning, intergenerational wealth transfer, and business succession. So it's definitely more than just investments. Okay. And fees, and investments do have fees, and they do matter. So all mutual funds have fees. They're called management expense ratio, MER, which is an annual percentage that is deducted from your investments. So added to the MER, there are some companies that may charge a front load fee, which means you're paying an upload or upfront fee on your initial investment. There could also be a backload fee, which means you may be paying a fee when you make the withdrawal. And it could also be a potential annual advisor fee. So it's very important to understand the fees of your investments because it can truly have an impact on your returns. So fees are important because, as I said, they have an impact on your returns. Cheaper is not necessarily better, and expensive is certainly not better if you're not getting the advice. So with management expense ratios, not only are you paying for someone to professionally manage your investments, you're paying for someone to provide you advice and to guide you throughout your life event. And having good advice could save you hundreds or even thousands of dollars over time. So there's a lot of Canadians that don't know how much you're paying in fees, which is really concerning. So I would just stress the importance of really asking questions about your investment fees and what you are getting out of those fees. So that's the focus of today's presentation. Again, thank you so much for having me here today. And I'm looking to see if anyone has any questions. Yeah, absolutely. When transfers are not taxable. Oh. So Chelsea was asking a question about transferring RSPs, whether it be a previous pension or personal RSP account, if there's any implications of transferring from one institution to another. There are no tax implications of transferring from one institution to another because it's a transfer, it's not a withdrawal. There sometimes will be transfer fees, and depending on the fees, you know, the financial institution usually would be more than happy to cover the fees. There's just some fees depending on the investment called deferred sell charges, which can be really significant. So we'd have to find a little bit more information about that. But with Canada Life, no, it's a flat transfer fee. Yeah.
Yeah,
sorry, didn't hear.
Yeah, well, yeah, that's what Leanne was saying last time, is that it is possible because we have RBCs on reserve, right? We could code it when we do the transfer that the investment would be on reserve, and therefore any interest that it earns would also be tax-free. And I think even because, I know when I locked in RSP too, right? When you take it out, there's, coding that if you earn it on reserve, then you don't have to pay when you take it out of the RSP because that's how it was initially earned.
Yeah, exactly. Again, it depends on the circumstances, but it definitely can be done. Yeah. Yes.
I'm not sure exactly where, but I know there definitely is. Yeah.
By Aurelia.
I talked to them once. I can't remember. I can't remember who it is. Yeah, is it?
Yeah, definitely doable. And looking to see, I know your line of expertise is mortgages, and did you want to cover that a little bit?
I can talk a little bit about it. I mean, I know sorry, Mike. I can talk a little bit about it. I mean, RBC does have a on-reserve mortgage program with a partnership with Nipissing First Nations. And, there's a couple, it's very similar to the process for off reserve when you're borrowing for mortgage on reserve. The financial rules are the same. The big difference is the down payment required is a little lower. The down payment required is only 2.5% as opposed to 5%. There is also no CMHC coverage. You don't require the CMHC coverage if you don't have 20% down. That's a difference too. Another big difference is the mortgage is open. So if you want to make a lump, if you had a mortgage now through the on-reserve program and you wanted to make a lump sum payment on it, then there would be no penalty to do so. But also you can pay it off in 8 point. If you sell your home and move, then there's no penalty to do that too. There's a number of different things that we look at. Like the three main pillars are your net worth that you would have, your credit rating, and your affordability would be basically the main things that we consider when we're looking at approving for the on-reserve mortgage. And if you are interested in one, what I would encourage you to do first is reach out to the Nipissing First Nations land office, and then they will do the initial eligibility to be sure you can apply for a mortgage, and then they would send that referral on to us to pick up the application. Any other questions?
No questions online?